New Mexico Real Estate Principles Workbook, page 52. Participation. If a taxpayer qualifies as actively participating and has adjusted gross income of less than $100,000, passive losses from those real estate activities may be deductible from the non-passive income for that year up to a maximum of $25,000. The deduction phases out for incomes from $100,000 to $150,000 and are not available for incomes above $150,000. M. Home ownership tax advantages. 1. Expense deductions. A. Homeowners may deduct certain expenses on their individual income tax returns. These deductions avoid the payment of taxes on some of our income. Interest on debt used to buy a home is deductible up to $1 million in debt. Interest on home equity debt of up to $100,000 not exceeding the fair market value is also deductible. 2. Property tax deductions. A. Homeowners may also deduct ad valorem taxes, which are property taxes, but may not deduct special assessment charges. 3. The Tax Reform Act of 1986 and the Taxpayer Relief Act of 1997. These laws are subject to interpretations. The following summary should not be used as the final word. We again urge the services of a competent tax professional. A. $500,000 capital gains exclusion for homeowners. 1. A second tax break that can be applied when a person sells their principal residence is the $500,000 exclusion for a married couple filing jointly, or $250,000 for a single filer. For most homeowners, this exclusion means they will never pay capital gains tax on the sale of their homes. 2. To qualify for this exclusion, a taxpayer must have owned the home and used it as a principal residence for at least 2 of the past 5 years immediately preceding the sale. There are no limitations as to the number of times this exclusion may be used in the taxpayer's lifetime. 3. Sellers that have accumulated profits in excess of $500,000 per transaction must pay capital gains tax on the amount of gains above $500,000. B. First-time home buyer down payment option. 1. First-time home buyers may make penalty-free but not tax-free withdrawals from their retirement accounts, IRA, in amounts not to exceed $10,000 used for down payment on the purchase of their home. Page 53. N. Investment property depreciation. 1. Tax shelter. A. Real estate is frequently called a tax shelter because the depreciation allowances that owners of investment or business real estate may take on their tax returns. 2. The 2 principal rules regarding depreciation deductions are the following. A. Depreciation deductions are not allowed for property used for personal purposes, such as a taxpayer's residence. B. Land may not be depreciated. 3. When land and improvements are purchased together for a lump sum, the purchase price must be allocated between the land and the buildings to establish the cost of the improvements for the purpose of depreciation. 4. The depreciation deduction is designed to allow an annual offset against income from that investment that will permit recovery of the cost of a building over its useful life. Residential rental property is depreciated over 27.5 years using the straight line method. Non-residential real property must use 39 years of straight line depreciation. 5. Under the straight line depreciation method, the cost of a building is recovered in equal annual installments over its useful life. For example, a building with the cost of $385,000 and a useful life of 27.5 years would be depreciated at a rate of $14,000 each year. That is, the owner may claim an additional expense of $14,000 per year even though no checks were written for this expense. 6. If the property had an original basis of $450,000 and the owner depreciated the improvement $14,000 the first year, at the end of year 1, his adjusted basis or book value would be $436,000. Note that depreciation was calculated only on the improvement. All deductions for cost recovery will be recaptured at sale and taxed at 25%. O. Capital gains. 1. Capital gain. A. Gain on the sale of real estate usually is treated as a capital gain. B. However, gain on the sale of dealer property is treated as ordinary income. C. Dealer property is property held primarily for sale to customers in the ordinary course of business. An example would be lots in a subdivision sold by a developer. 2. Capital gains must now be calculated based on the length of ownership and included with other items of the taxpayer's income. 3. Tax rates on capital gains range from 15% to 39.6%. The 15% rate applies to long-term gains on properties held over 12 months. This rate is reduced to 10% for taxpayers in less than the 20% bracket.